Now, if an investor could sleep through all the drama of a crash and wake up 5 or 10 years later, would they behave differently? Sure, absolutely. I showed you the Depression area crash was the longest one at 34 months. So if you slept through that and woke up 5 or 10 years later, you probably behave differently. You know, imagine, let's say you're watching a really good suspense thriller movie, right? A really good one, not a crummy one. And it's the first time you're seeing it, and you know the music comes in at the time and it startles you, and the guy comes from around the corner, and then, you know, the way they shoot the movie scenes and stuff, you're really on the edge of your seat the entire movie. But then you watch it a second time and a third time. When you're watching with another person that watched it for a first time, their reaction is different. They're unseasoned. You've been through it. You're seasoned, right? You've seen the end of the story. You know how it ends. That's why we spend so much time doing these classes and sending out the videos and doing our newsletters, so you guys know the ending. And that's why we need to teach you, so you know the ending to the story. What would it take to destroy it all? We could have an asteroid hitting the Earth, right? We just had one buzz by, right? 25,000 miles away, size of a bus or something, they said. And we know what that meteor did in Russia, right? Caused a lot of damage. But if this happened, my gosh, I think we'd be worried about where we're going to be eaten next. Nuclear war, it's always a possibility. But we can't think about that when we're investing, because we have other problems if this thing happened. Pandemic, wiping out billions of people all around the world. You know, these are the things that can destroy it all, that we can't really worry about. Just to be ridiculous, right? Aliens could come down, and that's provided what an alien looks like. I have no idea, assuming that they're bad. The world is not ending today. Short-term market movements are random and unpredictable. The right thing to do is just stay prudent and then rebalance on the highs and lows. Selling a little bit and buying a little bit. Not extreme. Guys have all flown in planes, right? Safest way to get from Los Angeles to New York is in an airplane. It's not walking, it's not riding a bike, it's not taking a bus, it's not driving a car. The safest way in an airplane. But chances are you'll have to take some turbulence sometimes. But they're built to take the turbulence. Your portfolio is built to take the turbulence, the volatility. To reduce the turbulence and volatility, we diversify using short-term fixed income and other asset classes. And here's what that looks like. The blue line is 100% stocks. Crazy volatility, right? To me, I can't personally take that. None of us in this room, I don't think, could take that. So we don't do that. But if you're realistic, you're going to end up with more money if you invest 100% in equities sometime down the road. You know, 1 million since 1991 grew to 9.6 million. 75% stocks, you can see less volatile. 50% stocks, which most of us are at, this is where most of my money's at, 50-50, 60-40, somewhere in that range. I do have some 60-40s. And then 25% is much less volatility. You have to pick the portfolio that's okay for you.